Thanks, Steve.
Thank you.
Okay, Sean, over to you.
I think this is the first meeting for about a year. I think we've got a lot of new members, so it's probably worth starting with introductions. I am Sean Collins. I am Head of Pensions at Oxfordshire. So I'm the independent chair of this meeting, and the Head of Pensions at Gloucestershire chairs my board. So that's who I am. I don't know, the easiest way of going round.
Okay.
I'll go round my ring. I've got Paul next to me clockwise.
Okay, thank you, Sean. I'm Paul Blacker. I'm the Director of Finance at Gloucestershire County Council. As many of you know, our Head of Pensions retired in April, and we haven't, at the moment, we haven't got a person in post, but we have got a new person that's in post that's starting on November the 9th. So I'm here in my role as Director of Finance and kind of acting Head of Pensions as well.
Okay, I've got John Arthur next.
Good afternoon. My name is John Arthur. I'm the Independent Investment Advisor to the Pensions Committee of Gloucestershire.
Andrea, do you need to introduce yourself?
Yeah, I'm Andrea Griffiths and I'm clerk to the board. Thank you.
Right. John Topping.
John, we can't hear you.
You're on mute, John.
He's taken off mute, so I still can't hear him.
Turn the volume up on your laptop, John.
Hello, can you hear me now?
Yes.
And yes.
Okay, hi. I think my Teams was interfering with my WebEx. So my name's John Topping. I'm one of the board members, and I'm from Gloucester City Council.
Okay, Nigel.
Good afternoon, everyone, and thank you, Sean. Yes, Nigel Moore. I'm a county councillor at Gloucestershire County Council.
Okay, I've got Michael Hunt.
Hello, everyone. Can you hear me?
We can.
Good. I was just hoping I wasn't having the same problems John was. I'm Michael Hunt, and I'm a representative from Unison. I'm an employee of the Gloucester City Council in John Topping's team.
Okay. My screen says Rebecca Hartson.
No, that's the YouTube. Sorry, Sean, that's Rebecca's the YouTube film. If we can go to John Abbott, if you'd like to introduce yourself, John.
Yeah, I'm John Abbott. I'm from Unison, a new rep, also like Michael. I'm the branch secretary and I'm employed by the County Council, but on full-time release for union duties.
Thank you. And to Paul Jones.
Thank you very much. My name is Paul Jones. I'm the Executive Director of Finance and Assets at Cheltenham Borough Council, and I'm very pleased to be attending my very first meeting.
Okay. Paula, would you like to introduce yourself?
Yeah, absolutely. I'm Paula. So I am from Highland Yorkshire. We are the fund actuaries to the Gloucester Fund. So I think on your agenda it said Julie West, but she couldn't make it today, so I'm one of the other actuarial consultants on the team.
That's lovely. Thank you. Okay, Sean, back to you.
Did we have any apologies, Andrea?
Yes, sorry, we do. We have apologies from Annette Benson.
Okay. So item 2 then is the notes of the last meeting, which was back in November of last year. I think John and Nigel, you two were the only ones there. Are there any issues that in terms of accuracy?
No, Sean. I've had a chance to look through those minutes, and I'm certainly happy to support them.
Thank you.
And how do I get them signed, Andrea?
No, that's fine. I will make a note of them in the minutes.
Okay. It's the comic of John is talking, or he's on mute, and I can see his mouth moving.
No, John wasn't present at the last meeting in November.
Was he not?
No, that's why only notes, because we weren't quorate.
Right. So
we can go on.
Okay. Item 3 then is the minutes of the Pension Fund Committee from their meeting on the 25th of September. And I think they're here for us to note or to raise any issues that we want to raise. I can see, Paul.
Yeah, the only item I've got is something I mentioned earlier, just to draw members' attention to the announcement that we've appointed new head of pensions. That's Matthew Trebilcock, who starts on the 9th of November, and a pen portrait should have been sent out to all board members. That's just to draw members' attention to that.
Okay. Is there anyone who wants to raise an issue on the minutes that isn't covered elsewhere on today's agenda? I think a lot of the items are on the agenda today.
Sean, if I might just say something there. Yes, I attended that meeting in terms of on behalf of the board, and as you say, I think pretty much all of the material that's there is on our agenda.
Okay. And Andrea, I can only see 9 screens, so I can't see if people have got their hand up or waving at me on.
Okay. So there is a function, if I can just make members aware, that there's a function on the bottom toolbar if you need to raise your hand in order to speak, or if you just like to put your hand up on the screen, and I'm monitoring the screen because I'm flicking across both.
Okay.
Okay.
So all I can see, there's nobody who wants to speak further on this item.
No. If we can go on to item 4, please.
Item 4, which is the market valuations and quarterly performance report. And I think, Paul, are you going to start on this one?
Yep. Yeah, thanks, Sean. I'll do a little intro. Just really to say the first 6 months of this year has been unprecedented time for many reasons, but this has also been reflected in the financial markets. Included in your pack, we've got the investment performance spreadsheets for Q1 and for Q2. Normally, we only provide the latest spreadsheet in your packs, but the board hasn't met since February. And I think the first 6 months of this year has been quite kind of volatile. So I think it was very much worth giving you kind of both quarters that goes from the 1st of January to the 30th of June. I mean, in summary, the first quarter saw one of the largest quarterly drops in stock market valuation in recent decades. And the second quarter saw quite a significant bounce back. The net effect was that the value of our funds, our invested funds, at the 30th of June were virtually the same as they were at the 31st of December. So we did have that dramatic drop in the first quarter, but a significant bounce back. So really, there was kind of little change. But it has been a volatile 6 months. And in order to give the board a greater understanding of what's happening in the last 6 months, I've asked John Arthur, our independent investment advisor, to brief the board and to answer any of their questions. We don't normally have John here, but I think because it's been such a volatile 6 months where the investments have gone down and then back up again, I thought it was helpful to board members for John to give a presentation for his interpretation of what's happened, why it's happened, and maybe his thoughts for the future. Unless there's any questions, I'll pass over to John.
Okay. Andrea, can you share the charts, or do you want me to do that? I'm not sure if I can actually. Can I?
You share them, John. I can't share them from my iPad, I'm afraid. Everyone's got them in their packs if you'd like to refer to the page numbers otherwise.
Can people see that on their screen?
They can. Thank you.
Right. Okay. Excellent. So just as a very brief introduction, my name is John Arthur. I'm the independent advisor to Gloucestershire County Council Pension Fund, to the investment committee. My background is nearly 30 years as a fund manager, the vast majority of which, 26 years, was within what was originally British Gas Pension Fund, a scheme that had 130,000 members, was valued at about 4 billion when I joined it in 1986, and valued at about 14 billion when I left it in 2012. 2012. My role there was as an equity fund manager and then investment director, responsible for agreeing investment processes used both by the in-house team managed and by external managers that were used in some more resource-intensive asset classes like emerging markets, etc. And then the last 2 years I spent working with the trustees as the fund went through a major restructuring, closing to new members and moving to a liability-driven investment stance. 8 years ago, I joined what was then Annenbridge Epic and became an investment advisor. I advise yourselves, London Borough of Bromley pension scheme and the court in Northern Ireland. Money's held for Waters Court, etc., and then do project work again, all of which is with asset owners, so institutional asset owners, pension funds, sovereign wealth funds, charities, foundations, etc. Moving to the first slide, and I'm aware this is probably more Paula's than mine, and she may cover the same ground, but really I wanted to put what has been an incredibly volatile last 6 months into perspective. And these figures do come from Hyman's report, so a belated thank you to Paula for being able to pull these out. It shows that actually, although the funding ratio has dropped, and the last figure is for the end of June 2020, you can see that it's still at 97%, so the fund is okay. It's not, the last 6 or 7 months have been very volatile, and at the lows in March, the funding level was probably below 90%, but it is now back up to 97 with the recovery we've seen in markets. And as you can see, the performance of the dark green bars, the asset side, has been very strong over the last 10 years. The value of the fund has risen from just over 1 billion to over 2.5. The problem is the value of the liabilities have also risen, and the liabilities are the calculation that your actuary, Hyman's, make of the cost of future pension payments going forward, so both existing entitlements and future accruals to existing members. And it shows that the fund is roughly fully funded, and the next time Hyman's will do a revaluation, a formal revaluation, the last one was 31st of March 2019, the next one will be 31st of March 2022, so there will not be any changes to payments due from admitted bodies until there is a revaluation of the liabilities and assets in the fund and the funding level starting on 31st of March 2022. So although markets have been volatile, that shouldn't affect underlying payments from admitted bodies. So I think that's really this chart's really just to calm nerves slightly. The fund isn't hold below the waterline, it is okay. On an ongoing basis, assuming the fund remains open, funding level is close to 100%. Having said that, the sheer scale of the volatility we saw around end March this year, and then the recovery in April, you'd probably regard quite certainly as a once in a generation event. In terms of the mathematical calculation of standard deviations, it was well into a sort of 2 standard deviation event, i.e. 1 in 2.5% probability. So it was a very volatile period. And looking at what caused it in terms of the pandemic, then again, that makes sense of it being a once in a generation event, one hopes, certainly looking backwards. Moving on to the second page, I've tried to show where that volatility has come from. So looking at this, you've got the last 5 quarters to give you an idea of context. You've got the fund return for each of those quarters. And as you can see, through 2019, the fund was up, 2-4% or so each quarter. That was a good return. It was fine. Sorry, the benchmark was also up that sort of level. Number of quarters the fund underperformed, and other quarters it outperformed. But it was doing as one would expect. And then we had the major effect of the first quarter, and this puts it in context. The benchmark fell 11.5%. The fund fell over 13%. And nearly all of that happened in the last 2 weeks of March. So the change in value of the fund was 339 million in the first quarter of 2020. That's how much the valuation of the fund fell. In particular, it was the valuation of equities, the equity portfolio, that fell the most. And there are 2 reasons for that. One is it's the biggest proportion of the fund, and the second is it is the most volatile asset class. It's far smaller change in bonds, value of bonds, and because property is what we would call an illiquid asset, there's no day-to-day pricing of it. And because the major turmoil came at the end of the quarter, that turmoil, it wasn't picked up in property prices immediately. This is big commercial office blocks and etc. And therefore it was only in the second quarter that values began to catch up with reality. So that shows that A, the first quarter and second quarter were very volatile, and B, that most of that volatility was driven by the scale and the high volatility of the fund's equity portfolios compared to other assets within the portfolio. The figures in this chart don't add up, so the change in value of the fund isn't entirely accounted by change in value of equities, bonds and property, because there is another asset class, which is alternative assets. And the reason that isn't on this chart is because the fund was putting money into, so investing into these asset classes, so it's difficult to disaggregate new investment from capital returns. The other issue is the fund is still receiving money in, and in particular in the second quarter of 2020, did receive about, I think it was 41 million in as prepayments from admitted bodies. So there was a cash inflow which helped the recovery in the second quarter. The next chart really is about that volatility of the equity portion of the portfolio and the moving gently towards a new strategic benchmark. So what you've got here is the asset allocation of the fund. So you can see in the first column at the end of the year, 63% was invested in equities. By the end of the first quarter, end of March 2020, that had fallen to 59.7%. And that wasn't because the fund was selling equities, it was purely because they'd fallen in value. And then by the end of the second quarter, with the recovery in equity markets, the weighting of the fund to equities had increased back to 61.5%. This compares to the existing strategic benchmark allocation of 58.5%. So as I said, over 50% of the fund's assets are invested in equities. This is because the committee believe that over the very long term, equities will provide the best return. But however, they are more volatile than many other asset classes, most other asset classes. It shows the weighting to bonds and property, and then the weighting to alternatives. And as I say, the fund is still putting new money into alternative assets, which is why that's shown as increasing over time. It also shows the cash, and that shows the new money coming in from prepayments to admitted bodies. So if you look at the fourth row of figures in, the strategic asset allocation as at 30th of June 2020, that is the existing strategic asset allocation of the fund. That is the allocation that it is believed will best provide the returns required to continue for the fund to be fully funded over the long term. That strategic asset allocation was reviewed and agreed post the actuarial review conducted in March 2016. Post the actuarial review conducted by Heijmans in March 2019, the fund again did a review of its strategic asset allocation and has agreed through that to lower the exposure to equities, to lower slightly the benchmark, this is benchmark, will lower slightly the benchmark exposure to fixed interest to bonds, to increase slightly the exposure to property, and to increase the exposure to alternatives. Part of that is to reduce the exposure to equities, which is the highest volatile asset class, and put more money into alternative assets, some of which will provide ongoing cash flows to the pension fund, particularly areas like direct lending and infrastructure. So it is trying to gently increase the diversification of the fund going forward, so to lower the volatility. And I think in the last 6 months, that need to lower the volatility is more apparent perhaps than we realised it would be as we started down this route. The problem with investing into alternatives is it takes time for those investments to be made. So you're investing in an investment in an infrastructure fund, say, it takes time for the manager to find the infrastructure assets he wants to invest in and then cool down your capital. And the time to reach that 13% weighted of the total fund is probably going to be 2 to 3 years from now. In the meantime, the fund will move slowly towards that new strategic asset allocation as and when they're able to invest the money. The other thing that's gone on in the last few months, probably in the last year, actually, slightly more than, was a move within the fixed interest portfolio. Previously, the benchmark for the fund included an exposure to UK gilts, which is UK debt issued by the government. this is regarded as the least risky form of debt. The problem is UK gilts are yielding zero, basically out to almost 10 years. So if you lodge money, if you buy government debt, they will pay you back the same amount in 10 years' time as you lent them with no interest due. And that's without accounting for inflation. So in order to improve returns, the fund removed UK government gilts from its benchmark and replaced that with a weighting in investment grade credit, which is bonds issued by high quality investment grade corporates, which has a slightly higher yield and thereby aid and boosting returns of the fund slightly, although increasing the volatility slightly. But as said, as we push further into alternatives, that volatility should come down slightly. The new strategic asset allocation going forward, 55% equities, 25% fixed interest, 10% property, 13% alternative assets, is predicted based on 10-year forecast returns for asset classes to produce a return of about 4.6% per annum, 4.8% per annum rather, and this is above the rate that the actuary requires for the fund to retain its current funding position. So as it's structured over the long term, the funding position of the fund is expected to increase. I use the word expected, I don't use the word guaranteed because we cannot predict markets. But based on past volatilities and future expectations of returns, the fund is expected to improve its funding position over the long term. I'm happy to stop there and ask if there's any questions anyone wants to raise. I've got a couple more slides, but this is probably a good point to stop and ask for questions. Andrew, shall I continue?
Please, John, nobody's raised their hand that I can see, so please.
Okay. So as you can see, what I've told you so far is the funding position is okay. Yes, it'd be nice to see it improved, but it's not, the last 6 months haven't been disastrous for the fund. We are moving to lower the risk in the portfolio, in the fund, but that's going to take quite some time to achieve. And in the meantime, there's limited choice. It isn't possible really to push into risk-free assets of government bonds, because then we wouldn't be producing the return the fund needs to retain its funding position over the longer term. The last slide I put up is just really to bring you up to date with where we are. So as said, made a big allocation to alternative assets, 60 million to private equity, 80 million to infrastructure, 80 million to investing in lending directly to mid to small sized companies, and 50 million to be confirmed to international property. All of that will actually come out of the fund's existing equity portfolios. So diversification should reduce volatility. On the right-hand side, I've just put an update there on where we are with Brunel, which I'm sure you're aware of. So all the fund's equity portfolios have transferred to Brunel in terms of management. The property assets transferred in the second quarter, and the commitments pointed out on the left-hand side of the chart there to alternative assets will also be managed through Brunel. The outstanding portfolios to be moved over to Brunel are UK corporate bonds, which is investment grade bonds, multi-asset credit, and diversified risk multi-asset portfolio. And all of that should be done within the next 6 to 9 months. At the end of that period, about 99% of the assets of the fund will be managed by Brunel. They're still owned and segregated within Gloucestershire, but they are managed by Brunel. The other point I wanted to pick up is ESG issues, environmental, social and governance. And in particular, just to note that I believe in Brunel, you have a very strong manager, and within the, I think 8 or 9 pools within the UK, within England and Wales local government pension schemes, I regard Brunel as at the forefront of tackling environmental, social and governance issues. They're a member of the UK Principle of Responsible Investment and have been assessed by the UN under those guidelines and rated above average on all criteria. They produce a responsible investment and stewardship report for Gloucestershire and a carbon metrics report, which shows the carbon intensity of each of the portfolios run by Brunel against the benchmark. Each of the portfolios run by Brunel is equal to or less than the benchmark in terms of its carbon emissions and carbon intensity. Perhaps more importantly to me, when Brunel go out and select a manager for their portfolios, and these are including the portfolios that your fund invests in, ESG criteria are one of the main issues that they use when deciding which manager to put money with. It's a key part of their challenge to managers on how they manage ESG, and they expect to see environmental, social and governance issues fully embedded in the way a manager analyses the investments it makes and chooses to make. So again, it's fully invested in how Brunel work. And as I say, all Brunel equity portfolios are less carbon intensive than their respective index. So I think the fund is in a good place financially. It would be nice if markets weren't so volatile and weren't so uncertain. It would be nice if there was a risk-free asset we could invest in to guarantee returns. There isn't. But at the same time, the fund has longevity on its side. This fund will be open, and people retiring now will be receiving their pension for the next 20, 30, 40 years. People joining the scheme now may well be getting their pension, gosh, even into 2100, the next century. So it has time on its side. And I think in Brunel has a pool that takes environmental, social and governance issues very seriously and is directing the fund in the right manner. Again, I'm happy to stop to take questions.
Thank you, John. Sorry, Councillor Nigel Moore has his hand up to ask a question.
Yeah, thank you very much. And thank you, John, for that very helpful account of the transition, which certainly from my recollection is very much what the Pensions Committee agreed, having decided to join with Brunel. But one of the things that I think did emerge from that Pension Committee meeting was, is it two of the members, the Environment Agency and I think perhaps Cornwall, were slowing down their transition from their own individual pension funds to Brunel. Am I right in thinking that? And is there any particular reason for that?
I'm not really able to make comment on either of those two funds, I'm afraid, directly. I think the issue is perhaps that, as you can see, Gloucestershire wants to commit monies to alternative assets, to international property, direct lending, infrastructure, private equity, as do the other 10 funds involved in Brunel. And so if you think that we're a tenth of the assets of Brunel, then our commitments are roughly a tenth of what Brunel are dealing with in putting into these asset classes. So they're putting between $1 billion and $1 billion plus into each of these asset classes in the next 2 years. That's a very high figure. And it may be that one or two funds are feeling that it won't come quick enough and acting outside of Brunel. Now that is a two-edged thing. If you do it outside of Brunel, then you have to assume you have the expertise yourself to make those sort of commitments. And it is time consuming and incurs cost. And the other is it does then become a distraction for Brunel. So there is an issue in my mind over the resources Brunel have in allocating to the alternatives and in managing the alternative investments and the speed they could manage those investments, get that money into the market, get it invested. But I think that is outweighed by using their skill set and expertise at the current time.
Thank you, John. That's really helpful. Thank you for your answer.
Okay, does anybody else have a question? If you do, please put your hand up as I'm going across the screen looking at you all. No, right, through you, Sean, back to the chair.
Okay, well, thank you very much, John, for that. There's no action for the board to take on that. That was for information only. So I think the next item might be as well. Are you going first on that, Paul, or are we going straight to Paula?
If I can just launch into it to start off with, please, Chair.
Yes, of course.
Okay. So, yeah, before I hand over to Paula, who's a representative from our Hymans, who are actuaries, just want to kind of make a few introductory things, really, to say that over the last kind of 6 months, there have been significant developments in the local government pension world. Some of them are quite complex, but I think ones that some of the board members might be interested in. So I've asked the actuaries to come along and do a presentation on these developments and the implications for the fund. I think it's also useful because we've got several new members. We don't normally have, so many external presenters, but I think because of the volatility of the market, I thought it'd be useful to have John, our previous presenter, and because of the number of changes that are taking place in the pension fund, and because we've got some new members, I thought it would be really helpful to have our actuaries here to actually go through some of the detail of those quite complex changes that you might have all heard about, but don't have the detail. So I guess I hand over to Paula, and if there's any questions throughout, Paula might be able to answer some, and I'll try and answer some as well if we've got any questions at the end. So I hand over to you, Paula, to go through your report that we published, which is the same as the one that went to the pension committee.
Great, thanks, Paul. So yes, as Paul mentioned, the LGPS is a bit of a regulatory minefield, if you like, at the moment. There are so many different consultations flying about, so many different changes to the regs, different cases going to the Supreme Court and everything. So this paper was intended to bring it all together for you in one place. It will serve as a helpful reference in the next few months as well. So it's good to keep it handy. I was just going to run through very briefly, kind of high level, each of the things that are in the paper, and then happy to take questions as we go if anybody's got any. Is that okay? So the first one up is the McLeod judgment, and anybody in the public sector world seems to know the name McLeod, which is actually the name of a person, a judge in the judges' pension scheme, the judicial pension scheme, who challenged the transitional protections that are on all of the public service schemes following the reforms in 2014. So prior to 2014, we had a final salary scheme. In the LGPS, it was 1/60th of final salary, and your benefits were linked to your final salary. So increase the salary increases and a retirement age of 65. Following 1st of April 2014, we moved into the new CARE scheme. So it's a career average scheme. Your benefits are linked to CPI, and it's a 49th for every year of accrual that you get. And crucially, the retirement age moved to be in line with state pension age. Similar changes happened across the public sector schemes, although they were all slightly different in the police scheme, the fire scheme, the NHS, etc. But they all had some form of transitional protection aimed at protecting those that were close to retirement. So within 10 years of retirement was the cut-off. If you were within 10 years of retirement, then you got the best of both. When you got to retirement, your benefit would be calculated on both had you remained in the 60 scheme, or if you'd moved to CARE, and you would have got the best of both worlds. The McLeod ruling basically said that this was age discrimination. It penalised younger members, which it does. The government tried to come back and say, well, yes, it does penalise younger members, but younger members are essentially younger and therefore have longer to save for retirement and make different plans for how much they want to budget for retirement, whereas people within 10 years don't have that time to make up the benefits. The Supreme Court didn't take that argument, and they said it was age discrimination and that something should be done to remedy this. So they didn't almost take away the protection that they'd offered to the people within 10 years, because those had become accrued benefits at this point. So they need to do some sort of levelling up so that anybody that was not entitled to the transitional protections is afforded the same protection. And essentially that's what they've done. Anybody who was a member of the scheme in 2012, at the time that these reforms were kind of put in place, if you were an active member of the scheme in 2012, then the protections will apply to you. What this means for us is, in terms of liability impact and therefore impact on cost of the scheme, the whole fund impact for Gloucester is expected to be about 0.1% of the whole fund liability, so it's pretty small beans. For employers, it may be a different story, and it will vary wildly for different employers depending on what their profile looks like and how their membership profile is. So some people that have a lot of younger members could feel this impact a lot more because they are then getting this protection introduced for these younger people that it wasn't there before. Even though it is a lot more than the whole fund, we are not expecting anything to be above 1%. So you're probably talking in the range of 0.1 to 0.7 for Gloucester based on the data that we have. So it's not massive. The 2019 valuation, so we were not, when we did the 2019 valuation, this additional liability was not to be included because the ruling hadn't actually come out yet. So the actuaries and the LGPS were instructed to make some other allowance for the fact that there could be an impact on the cloud. So what we did was we increased the likelihood of success. So how likely as an employer to meet their funding obligation, we increased that bar for everyone, which meant that all employers got a slight increase in contribution rate, which as a result is to be the buffer for this. So it is built into the funding plans already, even though we don't know the exact liability impact at the moment. The bigger issue for McLeod will be the admin side of it though. It is expected to be a massive project. The amount of data that has to be gathered, processed and kind of benefits recalculated is going to be a headache for all funds. Gloucester are quite fortunate. Alan Marshall, your head they have maintained collecting certain items of data that weren't actually required under the care scheme. So part-time percentages and change in hours. Alan has maintained collecting that information since 2014. So he doesn't think it's as big of a job to go back to some employers to get this information because there's only a few missing. There'll be kind of different strands to the project, so it will be identifying all the members that are affected by it, recalculation of any benefits that have already been paid out, so anybody that's now a pensioner and has retired in the last few years and should have benefited from this, need to go back and calculate their benefits. There might be arrears to pay because of it, so it will be a huge project. Like I said, on the actuarial side, we're not terribly concerned with it. We're not expecting massive hikes for any particular employers at the 2022 valuation in terms of contributions, but the fund will certainly feel the impact for a while on the admin side. Any questions on the cloud?
Can I just raise something, Paula?
Yeah.
Just really want to reiterate the fact that the big impact is going to be on the administration, as Paula says. And I know a lot of funds are really concerned about it, but it's really just to reiterate some of the stuff that Paula said, that I think we're in a much better position than other funds because we have got that base data. It will mean more work because, in fact, we have to do the job twice. We have to work out two sets of benefits for people who retire. But we are in a much better position than a lot of local authorities. And that's be one of the first tasks for the new kind of head of pensions to come in to assess whether we are as ready as we think we are, and also to set up a working group so we can actually work out what this means in practical terms for the staff and the administration staff who work in the pensions team. Yeah, so I hand over to Paula. Thanks.
Okay.
Sorry, Paul, can I ask a question?
Yeah.
Has this been discussed with the committee, and if you need additional resources to deliver this project, have they already agreed in principle that they'll provide additional resources to you?
It was discussed at the committee meeting, and and there was an understanding that we might need additional resources. So part of this will be to assess whether we do need additional resources, what they are, and then go back into the committee to sort of outline that case. I don't know whether Councillor Moore, who was at the meeting, would like to add anything to that.
I think you've summed it up well, Paul.
Yeah, I think there had been a lot of talk, certainly with people discussions as well, that the kind of first major step in this is actually going to be the project plan. And so once the new head of pensions starts and gets the work to put together, that'll be their first task. And then at least when the project plan's fully complete, which I think the paper has the kind of what we think should be in that project plan, at least when all those dates have been worked through, it'll be more clear at what stages different resource will be required, because that will vary across all the funds as well, because a lot of resource will be required for funds to collect the data from employers that they don't have. Of course, I might not have as big a team for that, because there's only a small bit that they don't have, whereas others don't have any information on any of this stuff since 2014. So there will be a bit of a balance to be struck there. Is that okay, John? Does that answer your question?
Yeah, I think from Oxfordshire's perspective, we have also been collecting the data where we haven't loaded it onto the system. So I think we're probably in a similar situation to Gloucestershire. But I think one of our worries is that, as Paula has said, all funds will be looking for this additional resource at the same time, and therefore it's going to be scarce. So I think there is a real risk which the board needs to recognise about how well we can run this project.
Yeah, from HIMA's perspective, certainly as well, is encouraging funds to make sure that the software providers are working on this. They obviously have to put in place calculations on the systems, and we don't have a contractual relationship with them. There's nothing we actually can do to encourage them along, apart from tell our funds that you need to be on their backs to make sure they are making progress with this, because you won't be able to manually process these calculations. You won't be able to track the data unless they get the software updated. So it's down to Haywoods and the other providers to do that, and making sure that they make a conscious effort for it, because it will probably take them the best part of a year to do it. It's not small changes we're talking about.
Yeah, just to say, I mean, we're with Haywoods. I'm not sure whether Oxfordshire are. They're one of the biggest providers, and I know they're beginning to work on it already. And there's quite a few pension funds who will be on their back pushing them to do it, and they have got the majority of the pension funds in the country. So hopefully they are onto it, and we are actively monitoring them.
Yeah, it's the actively monitoring that. It's just like anything else. It becomes a risk if they don't. So it's that is where you want to be monitoring the progress as well as with your own internal project. Any more questions?
No, nobody else got a question, Paula? No.
Okay, so the next section on the paper was about the cost management valuations. So these are national valuations that happen, one with the Treasury and one with the Scheme Advisory Board. And the idea of them when they were introduced was to keep costs for employers within a 2% buffer or a 1% buffer, depending on which valuation you're talking about. They were introduced because employer costs for the LGPS scheme was increasing and had been increasing over subsequent valuations for quite a few cycles. So they introduced these with the aim of having a cap on how much employers would pay. If it fell above that cap, then they would do something to either change the member contributions or change the benefits to bring the cost back into line. When it was introduced, however, they also mirrored it, so it also included a floor of 2%. So if the cost actually dropped below 2%, then the benefits would be improved, or employee contributions reduced in order to bring the employer cost back within this 2% buffer. It works in theory because they never expected employer contributions to fall below the floor, but the 2016 Treasury valuation basically found that had happened, and it comes down to the fact that the factors that are taken into account in these valuations are only things that can be controlled by the employers, and so investment return is not one of the things that are taken into account. And because the investment returns in the LGPS over the prior years had been really good, they fell outside this buffer. Anyway, it all went on hold because of the McLeod judgment, and they thought, well, actually, if benefit improvements are going to come into play because of the McLeod, so people are going to be entitled to this transitional protection that weren't before, there's going to be an increase in cost, and actually this might not be a problem. So it all went on hold, and it's only just started back up again. They have now said they will take the McLeod judgment into account in this valuation, so we don't know what the outcome is going to be, although the expectation is that it might now not fall outside the 2% buffer, so there might be no impact on the benefits on the back of the 2016 version of this valuation. However, they are now getting ready for the 2020 Treasury valuation, so they do them every 3 or 4 years. They have asked funds for the data for the 2020, or are about to ask funds for the data for the 2021. And at the moment, they haven't yet changed the criteria of these valuations, if you like. So it's still got the lower buffer and the upper buffer on it. They did say that they would review the mechanism as a whole to make sure that it does actually follow what was intended to happen. So it was supposed to put a cap on how much employers would pay. It wasn't supposed to increase benefits to members every time it happened if there wasn't a reasonable cause for it. So they haven't done that yet, although we just have to watch this space and wait and see if they do before they publish the results of their 2020 valuation. Given they take a while with these valuations, it could evolve quite a lot before we actually get to the result of it. Is that okay on that one? Any questions?
Yeah, if I just add, Paul here, just to add that, yeah, it's one of these complex changes that we have to keep an eye on. And in the long term, as Paul has said, there might be no impact. So I think we have to kind of watch this space. And obviously, if there is an impact, we will bring that back then to the pension committee and the pension board. So it's really just keeping members advised that it's going on and we're keeping an active view on it. But as Paul has said, the change could be minimal, or if at all, but we just don't know at the moment.
Yeah, it's one to just have on the radar because it is in the kind of in the papers and in the LGPS press and stuff at the moment because it's restarted, because they put it on pause with McLeod and now they're restarting it and they've said they're going to restart it and they're now out looking for data. It'll probably cross your desk on some sort of news flash at some point, which is why it's in. But as Paul said, it's definitely one for just noting at the moment, and we'll come back to you with any other information that comes to light. So the next one is the public sector exit payments, otherwise known as the 95k cap. This is probably the biggest one that's come into play in recent weeks. So I thought the easiest thing to do was to talk about kind of what happens now and what's going to happen. So at the moment, someone retiring who is aged 55 or over would potentially get a statutory redundancy payment, any other kind of payment like a severance pay or a kind of enhanced redundancy payment, and they would have an early retirement strain cost because they're going to be getting their full benefit early. So we've maybe budgeted for them to have their benefit from 65, and if they're taking it at 55, it's going to be paid for 10 more years versus what we were expecting. So there's a bit of a cost there. At the moment, that's what happens. However, there's new regulation being introduced, and the the crux of it is that the total of these payments to any public sector employee cannot exceed £95,000. So that's where the 95k cap, if you like, comes in. So there will be a cap on how much you can get, and it's all very complicated now. And it basically means that all members will have some sort of choice on what they do. They can't get all three of these things unreduced anymore. There will be a cap on it. So each early retirement that is paid out will be a kind of individual case, and will require discussion with the employer and the employee. They'll have different options to take, and to make sure this cap is not reached. The detail of it is all in that paper there, but it's fairly complex, and not the crux of it is you can't exceed 95k of an exit payment for a public sector employee. Crucially, they are due to come into force pretty quickly. So this has been talked about since like 2015, and then they released a consultation on it not very long ago, and they're now expecting them to come into play from 4th of November. So the biggest hitters on this might be people like councils or anybody that was planning big redundancy exercises for next year. They might see that they actually have to go back and do some calculations again on what they're going to be able to pay these people in terms of redundancy payments. Any questions on that one?
Can I just quickly add a point to that, just to say that we've received an email today from the Local Government Association, which kind of adds to the complexity a bit, really, by saying that the exit payment regulations will come into force, as Paul has said, on the 4th of November this year, but that's in advance of any changes to the LGPS pension regulations. So from the 4th of November to when these new regulations are enacted, there is a position of legal uncertainty, was the quote in the Local Government Association press release, and it says this is due to the apparent discrepancy between the obligation of the scheme members under the new cap regulations to keep the payments under 95,000, but the current requirements to pay unreduced pensions to those qualifying members over 55. So there's that divergence at the moment between the two legislation, the two rules, until the local government pension scheme regulations are updated. There's that bit of legal uncertainty. And the LGA have said there will be a government communication shortly to administrating authorities on this matter. So it's a big change, but from the period the 4th of November until the new regulations were enacted, there was a period of significant uncertainty about how to apply them. And that is a significant issue if any councils or organisations, employers, are planning some big redundancies between now and the new financial year.
Yeah. So the LGPS regulations haven't been changed yet, so they still say what they get at the moment is if you're over 55, you get an unreduced benefit, and the employer is responsible for paying that strain amount. But now the employer can't pay a strain amount if it's over 95k as a total package. So you're getting that bit of discrepancy there. The LGPS regulations, they're not expected to be updated anytime before the new year, and whether they actually come and the updates go through before the 31st of March next year, or if we'll be into the new financial year, remains anybody's guess.
Paul, the Scheme Advisory Board has taken advice from Queen's Counsel on this, because there's real concern that pension funds will be asked to act outside of their legal responsibilities in the interim period from the 4th of November until the LGPS regulations are amended. And that advice, again, should be with administering authorities at the beginning of next week. So it is something, as a pension board, given our responsibility is to ensure that the Pension Fund Committee is working within the regulatory powers they have is something I think the board needs to take a close eye on, because I think because of the way the government have introduced in the regulations, they are creating a situation where the pension fund committee is going to be challenged around its regulatory duties, either by scheme members who are asking for their payments to be paid in full in accordance with the regulations, or scheme employers saying they can't because it'll breach their 95 cap requirement. So it is an area I think that both the pension fund committee and the pension board need to pay close attention to. Hopefully it'll begin to get clearer once we get the advice next week.
Yeah, I think it's with the dates finally being set at the 4th of November, it's now a flooding of activity, like you say, with trying to get advice so that all pension schemes are able to like adapt to it and either put things on hold or pay them out and all in one way, because otherwise you're going to have one LGPS fund following one set of regulations and another LGPS fund following another set of regulations, and neither are technically in the wrong. So it's very much a watch this space for the next few weeks.
Sorry, Paula. Councillor Nigel Moore has a question.
Well, really, it was just a piece of information for the chairman. Looking at my diary, the next meeting of the Gloucestershire Pensions Committee is on the 4th of December, so that would seem to be an opportune time for me as a board member to raise the issue with the committee.
It may be, but the real question is if there is a requirement for redundancy between the 4th of November and the 4th of December. And I think the difficulty will be is in what decision the pension fund makes if it gets a request in that period. And hopefully the legal advice that we receive next week will make it clear. I'm not sure, Paul, if the committee has been briefed on this potential legal issue.
Yeah, I mean, they received the same presentation, and kind of the same issues were raised. Obviously, at that stage, it's going back all the way until the 25th of September. We weren't sure what the actual date was that it was going to be enacted, but it was raised as an issue that we'd have to keep an eye on. So while the regulations and the new law aren't aligned, it does create, as you say, a significant risk. And I think those decisions will have to be kind of made accordingly with legal advice. But I know from the Gloucestershire County Council's point of view, I think we would try and reduce those redundancies that take place in that period until we've got more clarity.
Yeah, I think the finalisation of the 4th of November date came out after the last committee, although we were thinking it would come into play near November. So Gillian said there was some discussion on it there. So they've definitely got their hat on if we need to watch this.
Okay.
I can't see any more questions.
Nope. So the next one on the list is the Goodwin ruling. So this is another discrimination case in terms of what the regulations say about the benefits, and this was raised in the teacher scheme, but again it's been decided that it will apply to all public sector pension schemes. Claim was down to the teacher scheme or any LGPS scheme or other public sector scheme providing a survivor's pension that is less favourable for a widower or a surviving male partner than for a widow or a widower of a female partner. So it basically said that there was discrimination on the grounds of sexual orientation and was upheld. So similar to McLeod, there will be some sort of arrangement to backdate the benefits for anyone who has been disadvantaged by this. So again, similarly to McLeod, we're expecting a very small impact in terms of liability, and in fact even less than what the McLeod is. So it'll be less than 0.5% across the board, is what we're expecting on the liability. But the admin of it will again be onerous. In this case, it could be more onerous in that they're having to go back to people who have potentially been a spouse of someone and they themselves have now died. So they might have to end up paying out benefits to someone's estate and finding any pensioners that are no longer at their receiving addresses and things. It could end up quite a complex admin task. Again, there'll be project plans and stuff for this one, but at the moment the focus is on the McLeod Relay, because for the Goodwin one, they haven't actually come out and said what the remedy will be, although they're expecting it to be similar in the sense that they will just allow everybody the same benefit regardless of what gender they are. Any questions on that one? That one sounds relatively simple once you've heard the McLeod and the 95k gap.
Sorry about that. Just to let you know, we've lost Paul Blacker at the moment. He's trying to reload and rejoin us. They're having a few issues with the IT. So hopefully he'll be back in a second. But that's fine if you'd like to carry on. Sean, would you like to go on to the next item?
If there's been no questions on Goodwin.
No good. Yeah.
Carry on, please, Paula.
Last one is just on kind of risk management stuff for employers, and this centred around a big consultation that was issued in 2019, covering lots of different things, and the remedies on the back of them for some of them, but not all of them. All of them came out. Big one is that it now allows exit credits to be payable to employers. So if an employer ceases in the fund and they are in surplus, an exit credit can now be paid to them. And it's clarified different calculations that can be done and different factors that should be taken into account when the size of the exit credit that can be paid is decided. So we'll come back to that in a second because we've got a separate policy on that one. There was also the allowance for the recalculation of employer contribution rates between triennial variations. In the past, there was a very small number of these could be done in very particular circumstances, whereas they can now be done at the request of an employer if there's been a significant change in the employer's covenant, or if there's been a significant change in the employer's liability. So it just gives it extra flexibility to the fund in that if they were monitoring, for example, the covenant of an employer and something happens, which is not outside the realms of possibility given the current COVID world, then if they think the covenant has reduced dramatically, then the employer contributions can be recalculated, even though we're not in the midst of a triennial variation. The final thing on this one was the flexibility on exiting employers. So if an employer has ceased or doesn't have any active members anymore, that would automatically have triggered a cessation before, and that payment would have been due from the employer if there was a debt left behind. Now there's a few options, and the employer can become a deferred employer, so it might be that they think that they will get a member in the future, so they can continue to pay their secondary contributions, which will be calculated at each valuation. Or they can go down the road of the same as it was before and they just pay the exit payment as and when it falls due. Or we can, the third option is to actually spread that exit payment over a period of time with agreement from the fund. So again, it's just a flexibility that allows the fund, if say, an example would be a kind of an admitted body, a charity or someone like that, who would struggle to pay an exit payment, but actually it's far too expensive for them to stay in because the costs are quite high and they've only got a few members. So by crystallising their debt and saying, well, we are going to cease and we don't have any active members, but we are allowed to spread that debt over a number of years, can be beneficial for both them and for and for the fund, because it means getting that money. It means getting that money in some way and not building up any more risk with that particular employer. So it's all about the flexibility that these things have added, and they are quite welcome. Any questions on those? Nope. So the following paper is on the exit credit.
I'll go on to that in a second, but I just want to. What I do want to quickly add at the end of that kind of thanks, Paula, for those points. I mean, I'm relatively new to this pensions world as well, and I would encourage those members, those board members who are new, to read the papers that were in again, because I did. You know, it is quite complex, and there's quite a lot of complex issues we've just discussed. But the papers, you know, it's really well described by Paula, but it's actually worth reading them again, the papers, because it does really give you a good insight into some of the complexities. And I certainly had to kind of read the paper again after being at pension committee to kind of understand the full nuances. So I think, especially for those new members to the board, that is a really good introduction to some of the changes that are taking place, either have taken place or are about to take place. So I would encourage people to kind of read those papers, and it really will give them a good, firm foundation of some of the changes that are happening to the pension fund.
It may be helpful, Paul, for me to point out I've been around in pensions for a lot longer than that, and this is an unprecedented time. I've never known the number of regulation changes we've had in the last 3 months over the probably 20 years I've been involved in pensions. So, as a new member of the board, don't be that frightened that you won't be getting this level of complexity thrown at you every board meeting. But there is clearly a requirement to understand the regulations as part of your role on the board. So it's a slightly unfortunate first meeting to be thrown this level of complexity. It does get easier.
Thanks, Sean.
Okay, are we happy to move on to agenda item 6?
Yeah, if I just do a little introduction before handing over to Paula. This one is kind of exit credit payments. And what I want to do is, at first point, just to clarify that this is about exit payments to employers. The 95 cap that we were talking about earlier was employees. And just to say, this is about exit credit payments to employers. So just to kind of clarify that in case people get confused. So it's not about the exit payments to individual scheme members. It's about sort of employers. And basically, the pension regulations require that the fund to obtain a cessation or exit valuation for any employer who leaves the fund. Prior to May 2018, there was no ability to pay any surpluses to employers, but any deficits could be recovered. In May 2018, the regulations were amended to allow payment of surpluses when an employer leaves the fund. So the policy lays out the rules for calculating the surplus when an employer leaves. The policy is needed to ensure that all employers are treated in an equitable and transparent way. But it's important to note that no exit surpluses will be paid to employers who were part of the scheme before May 2018, when the regulations changed. This policy was considered and approved by the Pension Committee on the 25th of April. So therefore, it's here for information only, so people understand it. And Paula's here to probably give a more in-depth intro to it and to ask any of those detailed questions that I might struggle with. Thanks a lot.
Yeah, thanks, Paul. I don't actually have all that much else to add. So all funds have been implementing an exit credit policy in light of these new regulations. So this is the policy that Gloucester are going to be following, and we have had some cessations to this point that have started to go through this process to see if the payment should be made or not. So it's in the world of part pensions. So when an employer ceased in the past, they made up a deficit if there was one, so that they exited with no debt. But if there was a surplus, they were not entitled to that back. Now, in certain situations, they are entitled to that back. and so you have to set a policy for how and when you'll pay these out, which is what this does here. There are certain exclusions in the Gloucestershire one which are not dissimilar to what we've seen across the board. For any admitted bodies who were in the fund and joined the fund before May 2018, they will not be entitled to an exit credit payment because it seems that their contract came into payment before there was this sort of new world, if you like, where exit credits could be paid, and therefore the terms and their contractual arrangements won't reflect the fact that that could have been done. So exit credits won't be paid in that case. And they'll also not be paid to town and parish councils in Gloucestershire. And the reason for that is that they benefit from a pooling arrangement. So they were set a contribution rate based on a pooled rate at the 2019 valuation. So they're in a risk sharing agreement with each other. So they're not going to be entitled to an exit credit if they leave either. Any other employers, they are entitled as per this policy, and they are all crucially looked at on a case-by-case basis because there are certain things in here on how the calculations will be done for different types of employers and for different factors that will be taken into account. It is worth saying that this is also the guideline that the fund will follow, and if a case came up that actually didn't really fall into these guidelines, then it could be looked at again. It's not a be all and end all. We can only look at this once. So you might find it evolves in a few years, although we do think we've captured everything that could come up as best we can at the moment. Any questions on that policy? Sorry, Andrew, I can't hear you.
I've got Councillor Moore and Paul Jones. They both have a hand raised at this point for question.
Okay, just to ask you, am I right in thinking that there's no appeal to any of this? Essentially, it's the decision of the fund is final.
Yeah, it's the fund's decision, but I can't imagine, Paul might correct me here, but I can't imagine the fund are going to make a decision and not hear an employer's argument at all. They are going to discuss it with employers, but yes, it is ultimately down to the fund to decide. If there was a disagreement on it, then it's down to the funds.
Thank you.
Decision. That's why it's helpful to have the policy though, because at least then the policy will go out for consultation. It will be in the public domain, and they'll be able to see that. That means that the employers can't say, well, that's not fair. I didn't know that, which is a good thing.
Okay, Paul.
Thank you ever so much. My first contribution. Yeah, I've been really interested in this particular area for some time, so I'm really grateful that there's now a policy. Certainly for my own benefit, I think it would be really useful for certainly me, maybe other members of this committee, to have some hypothetical examples so that we could actually see how this works out. And if I could just give two examples, because I'd just like to understand it in my benefit. So I don't know, Council X outsourced a service in 2015, brings it back in-house. There's a credit surplus for that particular contract. Clearly, that contractor would have been admitted to the scheme prior to May 2018, so the credit doesn't go to that contractor. I guess my question is, where does the credit go? Does it go back to the council, or does it just sit in the overall pot?
Yes, so the way, sorry,
that's the first one. Okay, yeah.
So the way that one works is because the council has outsourced that service, the service has come to an end and those people have come back in, so that entire pot has fallen back to the council. So part of that pot will be the surplus, and it will fall back in with the council's overall position. So it's not like the surplus is left languishing somewhere. You would get all of the assets and all of the liability back for that.
Okay. Hypothetical example two. These are probably live examples, but so in I don't know 2019, Council X outsources a service to an alternative delivery model, but given the necessity to have some sort of guarantee in place, there's a mechanism whereby they pay an additional fee to ensure that the contractor is no worse off as a result in fluctuations from the LGPS. So if, for example, that contract came to an end in say 4 years' time, technically they've only been paying a fixed fee because the council has been paying up the shortfall on any LGPS. Again, if they were to bring that in-house, would that exit go with the alternative delivery model, or would it come back to the council?
So again, that one will come down to the terms of the contractual arrangement that is in place between the delivery model and the council. So that's on page 1 of the policy. That's kind of point B. So if actually the council is standing behind that employer wholly and taking account of their fluctuations so that the employer always pays a flat rate, then chances are no, the council would get that surplus back, because they would have been the one that were on the hook had there been a deficit. However, at the other end, it wouldn't have been the alternative delivery model. So it would be the council, it would really, in that case. A kind of take on that would be, well, if you think of a hypothetical scenario C, that the same, it was an alternative delivery model in the council, but the terms of the contractual arrangement said that they were responsible for everything, a bit like a normal admission body, and the council were just a guarantor of last resort. So if they went under, the council picked up the bill, but anything else was the responsibility of the admission body, then in that case, the exit credit would fall to the admission body because they were the ones taking the risk.
Thank you.
Okay. Any other questions?
No, no other questions. Thank you.
Okay, that's me.
Okay, thank you very much, Paula.
Thanks very much. I'll dial off now if that's okay, but feel free to say if there's any questions that you have.
Yeah, thanks very much, Paula.
Thank you.
Okay, I think now we're moving on to agenda item 7. I think traditionally this has been the item that the pension board has spent most time on in looking at the risk register. I think, Paul, you're going to introduce this item?
Yep, I will do. Yep. As Sean said, this is a regular item on the agenda, and it's a tool by which the management and also the pension board and the pension committee ensure that all risks associated with the fund are regularly reviewed and assessed. It's quite a long list. Fortunately, there's quite a few greens on there. But what I'll do is I'll focus on the changes that have happened since the last risk register was presented. And obviously, as that was in kind of February, quite a lot has changed in the world since February. So there's one new risk, which is risk AR5, and that's a new COVID risk. And that's the risk that the COVID will have a detrimental impact on the ability to deliver a full service. I mean, what I'd like to say is that obviously that was a risk, and it's a risk that we recognised, but the pension team has responded incredibly well. The finance and investment team have been working from home since the beginning of the pandemic, and that's worked really smoothly. The pension admin team, by the nature of their works, meant that it was not possible to do all the work from home. So the work was divided into what could be done at home and what needed to be done in the office. The team was then split into two, with teams working in the office alternate weeks. So those teams working at home, obviously doing the stuff they could do at home, and those teams, the stuff that needed to be in the office was done by the teams that were in the office for that week. just to say that strict social distancing rules were enforced. Obviously, with not so many people being in the office, we could make use of other people's offices as well. Sorry, my phone just rang. Sorry about that. So yes, there was strict social distancing, and obviously also an enhanced cleaning regime that was in place. So I mean, the net result was that we continued to operate effectively. The calculation and payment of all new pensions were not delayed. The payment of death grants were not delayed, and the annual benefit statements were issued on time. So it was recognised as a risk, but that risk kind of was addressed, and we felt, and the performance of the team, they responded really well to the challenges COVID threw at them, and we did manage to provide an effective service throughout that period. But obviously, as COVID continues, there's still that risk that occurs there. So that was the one new risk. So there's 4 new changes to the risks assessments. That's F1. That's the risk that the fund fails to deliver anticipated returns. Sorry. This risk has increased due to the volatility in the markets that we went through when we did the investment analysis, and that's due to both COVID and also potentially the impacts of Brexit. But despite the dramatic fall in investments in the first quarter, as we learnt earlier, there was a bounce back in the second quarter. But however, the risks of COVID and the risks of Brexit create a load of uncertainty in the investment markets. So that's a kind of significant risk that has increased because we can't eliminate the risks of COVID and the risks of Brexit. Another risk that has changed, risk score has changed since last time, is F2. That's the risk that long-term investment strategy is not appropriate. Again, as we heard earlier, the investment strategy was approved by the pension board in February, but this was in a pre-COVID world. COVID has resulted in some delays in the implementation of this strategy, but as John mentioned, implementing the strategy does take 2 to 3 years while waiting for the right investment opportunities to come up. But COVID has resulted in some fundamental changes in the investment market. So one of the first tasks of the new pension manager will be to review the investment strategy to ensure it's still appropriate in the new world, and then obviously continue with the implementation of the strategic asset allocation. So basically that risk has increased because of the uncertainties around kind of COVID and the changes that have happened. So we do just need to ensure that the long-term investment strategy is still fit for purpose in the new kind of post or in the new COVID world. Another risk that's increased was the risk that the pension fund deficit will increase. That's F4. These ones are highlighted in yellow in your papers to show which ones have changed. The 2019 valuation, we were 102% valued, which was great. And this coincided with this compared with the 2016 valuation, where we're only 80% funded. And that coincided with why the fund decided to move away a bit from equities, because we could de-risk a bit because it was well funded, the scheme. High-level estimates, as John explained in his presentation, at June 2020 show that we're still about 97% funded because of that volatility in the market. But we still think that's quite good. But as a result of that and the additional risks, again, associated with COVID and what it's done to the investment market, we have increased that risk. And finally, G5, which is the risk we don't have sufficient skills and experience to administer the fund effectively. We obviously had to put that up because we haven't got a head of pensions at the moment, and also we lost kind of the investment manager. But as I said earlier in the committee meeting, it's good news. We have now got a head of pensions in post, and he brings a host of great skills and experience. So I'm pretty confident that that risk will be reduced again going forward once Matthew starts on the 9th of November. And then in terms, it also mentioned the finance investment manager, but as we've heard, all our investment assets should be with Brunel in the next 9 months. So again, we will assess whether we need those particular skills in future going forward, because as I said, all the detailed investment skills will be provided by Brunel. So again, one of the tasks of the new head of pensions will be to assess what this finance stroke investment manager, what skill set we want for that post. So as I said, with the new head of pensions, I'm pretty happy that that risk will be reduced going forward. So they're the main risks that have changed. But as Sean said, it is quite a long list. So, willing to, open to questions, really. Thanks very much.
Does anyone have questions?
No, nobody's indicated a question. Oh, John
Topping.
is just waving.
Hi, I don't know if it's a question for the risk register, but I'll ask it anyway, Paul. Just in terms of, you alluded to the Brexit thing. Has the any analysis have been where the pension fund, all its information is being held? I presume the county council's done something themselves. I'm just wondering if the pension fund have done that analysis themselves, or where information is being held. Where it's, is it being held in Europe? Is it being held in the UK? I mean, obviously, we as a council have done an analysis of ours. I'm just wondering if that's been done on the pension fund information.
I'll have to double check on that. My understanding was that all the information is held in the UK, but I will have to check up on that. Don't know whether you've done an analysis of that, Sean, in Oxfordshire.
We haven't, no.
Okay, I know that we've obviously done analysis ourselves as a council to see where all our information is stored, and we need to do that in lead up to Brexit, however that looks. So it was just a question. I didn't expect you probably to have an answer now, and yeah. It's probably just.
I know they have been doing it as the council, and obviously the pension fund are one of the, we do class it's part of the council, so that's been looked at by our information management team.
Okay, all right, thanks.
Are there any other questions? I'll ask one, Paul. Did you amend the risk register in light of the conversation earlier in terms of McLeod and 95 exit cap, etc.? Were there any changes to the risk register, particularly in terms of the ability to get sufficient staffing in to deal with the level of regulatory change?
It wasn't specifically looked at, but that really fitted with G5. The risk that we had the sufficient skills and experience to administer the fund. I guess we haven't quantified exactly what McLeod's going to mean, all those changes are going to mean, but so it will be incorporated in G5. So that would be one of those ones that we will kind of look at. But I suppose at that time when we last did the risk register, we couldn't assess it, so it was quite hard. It was a risk of uncertainty, but as we get more information, we will, include that in the risk analysis.
Okay, thank you.
Councillor Moore had his hand raised.
Thank you, Andrea. If I may, just Chairman, for the benefit of the new members of the board, it might be worth just giving a little bit of a background, because after the first few meetings of the board, I think the board's view was that the pensions committee weren't giving the risk register quite the prominence that it should have. And I think it was one of the early successes of the board to persuade the pensions committee to spend more time at its regular meetings on the risk register. That, in fact, because I try and attend all the meetings of the of the pensions committee, and I think that is what is happening. And I think during this last 6 months, it's really shown the incredible importance of this risk register. And obviously, there's been enormous changes to it since I last saw it because of COVID. But just wanted to give you that background, and I certainly can assure you that from my attendance at the meetings, that the pensions committee now does give a great deal of time to evaluating the risk register and also examining where additional risks need to be identified.
Thank you, Nigel. Does anybody else want to make any other contributions on this item?
No.
Okay, if people are happy to move on, then I think we're moving on to item 8, which is the pensions admin report. I think that is again is you, Paul.
Yep. Okay. Thank you very much, Sean. Okay. So this is one that we bring each year. So the first part of the report really describes how the team addressed the challenges posed by COVID, which I've explained, in a previous item about splitting the teams into two. But I think the information is shown in the summary tables that actually performance during a very challenging period, was maintained. In some areas exceeded. There were a couple of areas where there were some minor reductions in performance because of the difficulties we've had. But overall, performance was maintained and in many cases enhanced during this period. So I think that's great credit to the pensions team for working during what was quite a complex and challenging period. So haven't really got much to say other than that I would like to say, thanks, but give my personal thanks to the pension team who really did respond well to the challenges and ensured that performance was maintained during a difficult period.
Any comments on that aspect of the report?
No, nobody's raised a hand.
Okay, well, I think from the pension board, I think, Paul, we're happy to endorse that. Thanks to the pensions team.
Thanks. I'll pass that on.
Was there anything else in this report you wanted to?
No, I think that was it. Unless members have got any questions about particular performance, but I think overall performance was maintained during what was a challenging period.
Okay, I can't see anyone looking to speak. In that case, Paul, can you take us to agenda item 9, which is the business plan?
Yeah. Okay. Thanks very much. Yeah, this is kind of a bit delayed because of committee meetings were delayed because of COVID. So this is the business plan for 2021. It was approved by the pension committee in September. Hopefully, relatively self-explanatory. So I won't go through it in detail. Just be there to say that it was approved, and I'm able to answer any questions that people have got on it.
Does anyone have questions for Paul on the business plan?
Councillor Moore, you have your hand raised. Is that from the previous question? Oh, you've raised another hand. Can you unmute?
Go on mute.
Nigel, you're on mute.
I'm taking it down. Thank you.
Thank you. Okay. In that case, no one else has a hand raised or a question.
I think if that's the case, I believe that's taken us through the whole of the agenda items.
Yep, yeah. That's correct.
Yeah. Again, for the new members of the board, as Councillor Moore said, he tries to attend all of the committee meetings and normally feeds back any views of the board to that committee. I'm not sure from today whether there's anything in particular that we wanted to feed back to the pension fund committee. But there's an opportunity now, if anybody wants to raise any issues they want specifically to draw to the attention of the pension fund committee, or are we happy to leave it there and conclude our meeting?
Paul Jones has a raised hand.
Yeah, I guess this is it's probably not something that needs to be necessarily raised with the committee. It's more for my own benefit, and apologies, I probably should have asked this earlier in the agenda when John was going through the investment. So I guess just for my own benefit, I noticed that obviously historically there's been quite a bit of exposure to equities, and as has been described today, due to COVID, we've seen a lot of volatility in that area. Almost like the norm curve up and straight back down. But I noticed within the strategy there's obviously a sort of diversification into more property assets. I guess my question is, as one who's invested in commercial property locally for my own local council, and of course is mindful of some of the negative press, again, in light of COVID with what's happening in some sectors, is when we invest in property, whether it be in this country or overseas, are we directly investing in property whereby we are the physical landlord, or are we investing in a property pooled fund whereby we are obviously in a pooled investment fund and I guess own multiple property assets along with other sort of holders? I don't know whether there's anybody who can answer that question direct. Apologies for almost picking it up as AOB.
I mean, Paul, we would look at doing it through a fund. We wouldn't invest in particular properties. So we look to do it through Brunel, who would have a property fund. and then we would say what we wanted from that property fund, and they would look for investment managers who had a fund suitable that met our criteria. I don't know whether Sean wants to add anything about Oxfordshire.
We do exactly the same. We don't invest directly in property. We invest through fund of funds or funds.
Okay, thank you. I thought that probably would be the answer. So I guess then in terms of for Councillor Moore to take back to the committee, and it may be a close, a closed no, that's not something we want to do. But given the impact of COVID and given the recovery of Gloucestershire in specific, are there any sectors whereby we might want to consider direct property investment? I can certainly think of one that is obviously prominent in probably the whole of Gloucestershire, and that's obviously cyber related, where obviously there's a lot of prominence. And would it be a consideration for us actually to take some direct investment in the physical property infrastructure assets in Gloucestershire? So there's my contribution for consideration.
Paul, do you want to make any comments on that proposal now?
Well, I think it was a request to take that back to the committee. I mean, it's not something that we've done in the past, because obviously the fundamental objective of the pension committee is to maximise returns rather than kind of invest and regeneration within the area. So it's one of those things that I think we go back to the pension committee, and I think that being raised by the pension board, it is a legitimate question to raise. It's something that I think we've shied away from investing locally, just specifically locally for regeneration purposes, because our ultimate responsibility as the pension fund is to maximise returns.
Well, Paul, I'm very happy to take that question to the next meeting of the committee. We have had some interesting debates at the committee about infrastructure investment, and certainly I think as a proportion of the overall investment, infrastructure certainly has increased over the last number of years.
Okay, thank you. Are there any other comments or views that board members want to make, or back to the pension fund committee?
No, nobody else has a question or hand raised?
In that case, do we have dates for future meetings, Andrea?
Not as yet. This one was sort of arranged at a bit of a last minute in light of the pandemic. So I will look at dates, and hopefully we'll try and get a date in the diary for March next year. Is that okay?
Yeah, we're aiming to get one in before in this financial year, just because of COVID. We haven't had, as Sean said at the start, the last formal board meeting was in November, because the February one was not quorate. So we're quite keen to get one in March, just so we have the opportunity to kind of review things and keep the pension committee keep under surveillance, or not surveillance, but keep an eye on them. So I think we are trying to get one in March. I think will be the aim, if we can fit it within the timescale.
I'll start canvassing for dates.
Yeah, I think traditionally we've met just twice a year.
It is, yeah. That's all the board are required to do as part of the constitution.
Yes, I know the Oxfordshire board meets quarterly, which doubles the workload of the Gloucestershire member chairing the committee, as opposed to mine. But we're in the hands of the board if you believe you need to meet more frequently.
It is in the constitution that it's in Gloucestershire's constitution for 2 meetings per year.
So if people are happy, then we'll leave it to Andrea to canvass dates for the next meeting. And declare this meeting closed. Thank you all for your attendance.
Thank you.
Okay.
I'll just end the
Thank you.
feed.
Thank you.
Thanks all.
Okay.
Thank you very much. Right, still recording at the moment, Paul. I'm just waiting for Steve to end the feed.
Okay, I think that, yep. Well, thanks for that. Once everyone arrived, it was good.
Did have a bit of a moment.
Yeah.
That's right, he's just closing it.